So I'm going to start from the assumption side. We've already done the income statement. So this now follows what I explained. So when you have your numbers already for the previous years or for the historical years, ideally, the assumptions here are pre-derived. That's why you are seeing they are formula-based. They are all formula-based because they are pre-defined, okay? You already had the numbers. And these numbers come from where? Down here, where you had coded or you had put, you put the numbers directly. The numbers were put here directly, as you can see, okay? You just feed in. So in your case, you'll just feed in your numbers. If your revenue in 2018 was 1 million, you put. If it is 90 million, you put, okay? So this one is hard coded, okay? And where are we? We are now at, okay? So for all this, even depreciation, all of this was there because the assumption is you have already the financial record for the past. And that is why when I shared the first template, my assumption was to just allow you to put details of your past, to have this information. Once you have this information, we can compute the assumptions that you are seeing here. Okay, these are the assumptions we can compute. Okay, when you have this historical information, we can compute these assumptions. Okay, or we can capture these assumptions. Now, these assumptions inform us when we start moving ahead. Okay, when we start moving ahead, because the past informs the future to some extent. Okay, so I hope that answers a lot of our questions. If you have the records, for some of you, if you already had records and you filled the first template where you have your income statement, your balance sheet, and your cash flow for the previous years, for these next ones, it's going to be a bit simpler because it's easier to project. Okay, and I want to start by how do we go about? So number one, you'll see now we've computed the growth of the change in revenue, we've computed the cost of goods sold, because once you have those numbers from there, all you do is you feed. And when you feed, it helps us get the assumptions. Okay, salaries and benefit, this is how much we paid. Rent and overheads, other overheads, or I can say here, sometimes we just call this SG and selling, general and administration. But for simplicity purposes, I'll just say rent because it's common in most of us, and overheads. And you put the numbers, okay? You don't put where there's black, you feed in down here on historical, okay? And in accordance to the first template, we already had the historical information. And as far as we are concerned, we filled it, okay? We've filled the first, okay? And if you filled it right, you'll realize now, if I want 2021, how is my performance? If I did 16% in 2019, 11% in 2020, I can estimate and say, 2021, I'll do 15%. It can be low, it can be high, whatever you put, okay? When I put that, you notice my revenue changes because it is informed by the assumption, okay? So all I want you to do is just feed in on the blue side, okay? And if you don't have the assumptions for the previous years, but you have the numbers, just feed in on your statements, the assumptions will appear. Okay, they will change in conformity with what you've put. Okay, so I think this part we did. So I'm just going to our working schedules, and I'm going to start with here. Where's my? Are you seeing this accounts receivable? We said accounts receivable in our last terms. We said accounts receivable. This is money that we expect. We sold 50 bags of briquettes. We expect to receive it, but it takes some time for us to get it. Okay, some of us it takes 30 days, some it takes 20, whatever. So for this business, based on what they put, their receivable days is 18. Okay, their receivable days is 18. Like it takes 18 days for them to be paid once they sell on credit. Then inventory days, okay? The inventory days are the days, if I make my product, my briquettes, my what, how long does it stay in my store or in my shop before it goes to the market or before it is sold? Okay, so I look at, okay, my inventory days when I buy, it takes like 3 months, okay? So we capture that as an inventory day. For those of you who don't have inventory, you don't, but from all the businesses I've seen, all of you seem to have inventory, okay? So inventory days is how long your product takes before it is sold, okay? And okay, we are continuing. Then the other bit is accounts payable days. And we mentioned that accounts payable, these are money we owe. Maybe some people supply us, and we take some time to pay. Some of you have seen, they like associating this with Indians, that the Indians take long to pay. It means according to them, the account payable days are long to them from their business angle. But to you, your receivable days are high, are long, according to your side. So for accounts payable, this is money you owe people. You are supposed to pay them. So how long does it take? Now, according to this business, the accounts payable days is 37. Okay, it takes approximately 37 days for them to pay the people who they owe. Are we together? Then there is this deferred revenue. I'm just going to mention it. I don't know if there's any business which experiences it. There are some of you who receive money in advance before delivering a service. When you receive money in advance before delivering a service, okay, we call that deferred revenue, because now it becomes a debt you owe the person you are supposed to deliver the service to. That money is called deferred revenue. It is not really, it's not so much discussed, but I thought for some of you, I don't know if any of you receive money in advance before they serve. So I put it there for anybody who will have deferred revenue, then I will just guide them into how to incorporate. But I've put it there because there are those of you who receive money in advance before delivering a service. That is called deferred revenue. Capital expenditure, here you just put how much are you, I'm going to buy machine, I'm going to buy, the total spend I'm going to make here was 15. So for the upcoming years, how much do you expect to spend? It could be 30 million, 50 million, whatever you're going to spend to buy assets, that is where you put, okay, on the assumptions. Okay, then debt issuance or loan issuance and repayment. So when we get a loan, we usually pay it back. Okay, so at this point, this company took a loan of 20,000. Sorry, I use these figures from dollars, but I just wanted to keep Uganda shillings. So they picked 20,000. Okay, they are supposed to pay back this amount of money. They were given a loan, they're supposed to pay back. Okay, so here it's actually supposed to be positive. Sorry, let me just clear my drawings. All right. Yeah, so they took a debt. We are going to the schedule so that we see. They took a debt of 20,000 and they expect to pay it in 1 to 3 years. So they return. Now, when we are calculating debt, it's you picked money and you returned. The interest is calculated in elsewhere. So I'm going to show you where it is computed. So here you just show, I received this money, I'll pay. We received equity. This is also some form of finance, and they paid back some portion of it. When you pay, it is a negative. When you receive, it should be a positive. So I should be able to correct this down. Okay, so once you've put these assumptions, ladies and gentlemen, we go to the working schedules, and the working schedules are below supporting schedules. Okay, and this is where I'm going to pay a bit of attention on so that I can walk us through the supporting schedules. Okay, and these supporting schedules are based on what we've come up with. Okay, all right, so we're going to start with accounts receivable. Okay, now here it was computed that accounts receivable this year in 2018, they got account receivable of 5,100. Year 2, 5,904. Year 3. So for the next years, how much is the accounts receivable going to be? And they used the figures of the previous years to determine their receivable days. Now, what you see as receivable days is something that was derived. Let me show you how they derived it. Though you shouldn't worry about the formula. As long as you put the numbers, it is okay. So they calculated, I'm just going to put that number here. For example, this, they took, because accounts receivable means you sold, but you've not received the money. So I'll just take the 5,100 to determine my receivable days, divide by the sales. I'll go and pick my revenue. My revenue here is this. I'll pick that, and then I'll multiply times 365. 65. Okay. Okay. Sorry, this is okay. So that is what it gives me. Are we on the same page? Okay, I pick this over. Okay, so that becomes my receivable days. I can extrapolate, and it will give me, these are the number of days people take to pay me. Okay, I hope this helps. For payable days, for inventory, we look at for the inventory means before we sell. Okay, so I'll pick the figure, still the inventory. I'll say to calculate the inventory, I'll just pick this. You don't need to know because the formulas have done that for you. I'm just giving you a background of what happens. I'll go to cost of goods sold because inventory is part of cost of goods sold. Okay, I'll go to cost of goods sold, which is already here. Okay, and then I'll say times 365. If I get it, times 365. Okay, as you can see, it brings the inventory days as 73, so it takes 73 days. Okay, for accounts payable, still the same. Accounts payable is related with the cost, ideally, likely is related with cost of goods sold, because most of it is because we deal with suppliers. Okay, in most of our businesses, we're in production. Okay, for our context, it may be rare to find accounts payable from other assets. So I'll pick still from cost of goods sold over the cost of goods sold. Okay, cost of goods sold multiplied by 365. This helps me get to know how long it takes for me to pay the people who owe me money in business. Okay, and it gives us 37. Are we together? Now, when we have these figures, as you can see up here, and that is why it's already computed here. Okay, it's already computed here for most of us. Okay, now all we need is now project. You can maintain it, that I will still maintain. Okay, because as long as you have these numbers, you can compute the figures. Okay, so down here on our supporting schedules, sorry, where are our supporting schedules? So what we'll do is, because I have already made assumptions for the other years. Are you seeing? I've already made assumptions for the other years. Okay, for year, this is 2021, 2022, 2023. Let me just check. What possible measures can be taken for a company to recover account receivables that are overdue? Okay, let's first compute, because usually it informs you. For example, you may have money, but you don't have money. Have you ever seen a business that has money but does not have money? You may find it is because receivables take time. I've had clients who we have helped them fundraise a lot of money, but some of those monies were paid in like 3 years. That means my receivables lasted very long. You understand? So in terms of measures, usually you have to agree. Okay, you have to agree on the invoice. Okay, payments due within 7 days. You've seen the invoices which, and even put that, you know, you will incur extra, or there'll be extra interest charged. I don't know. Sometimes it's that, sometimes you just have to chase and communicate, when do you expect to pay? I'll pay on this date, that day you follow. Sometimes what do you do? It's relational. What I've realized, it's relational, but you have to make them see that you need the money and they need to prioritize. You know, some businesses, when you don't chase them, they also see it. This one has money. We shall pay him when we are okay. So they focus on their things while you are suffering. So sometimes you need to chase after it. I am one of the people who have had very bad experience working with some government entities where you've done some work, and I think because I did not understand what corruption is all about, they sat on my money for about 2 years. Okay, you keep on checking, but when they get the money and the budget, they prioritize their people. So that account receivable, it really pained me at some point. I said, unless I get from a subcontractor, I'll not work with most of these entities unless it is really clear. So those are some of the challenges, but how to overcome it, you need to keep on chasing. I actually chased and went to the superiors. You know, sometimes you chase on the person who is supposed to pay, but find delays since he's not prioritizing. So until I followed up also with the superiors, those are some of the approaches I can recommend, but there's no best way. It's just more of engaging, keeping that relationship alive and pushing so that they understand. Sometimes you may even say, okay, how much are you paying? Can you pay some money now? And we shall follow, pay now. You get, so that eventually they actually finish paying. So those are some of the approaches you can use. I hope that is clear. How does accounts payable and receivable days affect business operations? It affects, it really does. It really does affect. If you pay immediately and it takes long for you to receive money, it means you will always be short of cash unless you are so liquid. Because when you sell, you expect the money, then you pay people. So ideally, your receivable days should be shorter and your payable days should be longer. And that is why some people say, hey, these Indians, they sit with our money, what. Yeah, because they understand the art of payable and receive. And that's why their supermarkets, they will receive, and then they take a bit long to pay you, while the receivable days, they will chase after their money. And their receivable days, probably because it's a supermarket, they are paid immediately. You understand? That is, it affects the cash, the liquidity of the business, if I'm to put it that way. And liquidity is the life of the business. Okay, so you may find a company has a good product, but it doesn't have the capacity to produce because it sold some products on credit and it is waiting for like 60 days to get money. A good example is, for example, you get a government contract. You are going to supply ABCD. Okay, you supply the ABCD and they pay after 6 months or 9 months, depending on, okay? And it's a good business, you expect money. But now you cannot serve orders because probably you used all the money you had, okay? Now that means the receivable days are long. And probably the people who supplied you kubanjai. You understand? So I hope you understand that it affects the liquidity of the business. And it's one of the areas that if you manage to control, you can manage the liquidity of the business. But it's an interesting area to pay attention to. Any business needs to pay attention, because if you can manage receivables and payables, then you will find that you don't need a lot of external money, a lot of debt or a lot of loan. Most of loans we pick because our receivables are longer. And sometimes you get a deal and another deal and you have to facilitate it and you don't have the cash, so you have to actually pursue it. I hope that is clear. And that is why it is important to understand the receivables and payables. Is it clear? All right. Okay. So once you calculate receivable days and you've estimated, is there another question here? Okay, thank you. So, once you've computed, once you've computed your receivables, you'll see where it falls on the balance sheet. Okay. On the balance sheet, I'll come. Actually, it has been put. By the way, for your information, when we do the three statements, we usually fill this last because it's the one which helps us balance the equations. Okay, so you will see this as the usually filled last after we finished our cash flow. So you will see this is filled. Okay. It was computed here, and this figure is what you are seeing here on the supporting schedule. Sorry, in the supporting schedule here. It's already here. Okay, the receivable, what you are seeing on the balance sheet as receivable. Okay, and I'm just showing you. Okay. Sorry, let me just pick it. Receivables. This is receivables. It took, yeah. That is it. Okay, so you pick receivables. What else do you pick? Inventory was a different figure. Sorry, let me pick inventory. I had put one on top. Ideally, when you order on the balance sheet, you start with the one that is closest to cash. So we normally put receivable before we normally put receivables before. Sorry. This is a series, so I have to remove this. Sorry, just a small. Don't want to repeat these formulas. Just a second. Okay. So. Okay, so I'm going to pick the inventory. Where's the inventory? The inventory is here, F43. Yeah, this F43. I'll put here. Okay, I'll extrapolate. Then I'm going to change this again. I had put a different order, that's why you're seeing this, but it was on a different order. So for receivables, yeah, is receivables. Okay, sorry, let me just extrapolate back. Okay, so this is equals to, okay, yeah, that's it. Go and pick it from the balance sheet. that is how we interrelate the formulas. So once it is there on one place, it will just go on the others. Okay, so that is okay. Okay, so we finished the receivables and payables. Control 1, tables. Okay. Okay. Once you finish the receivables and payables and the inventory, okay, you are able to calculate our biggest interest is to find the change in net working capital. Okay. Net working capital is inventory and accounts receivable are, it means we expect money. Accounts payable, it means we owe people money. Now you can see on change in working capital, it is this one minus this one. Okay, it is this one minus this one, the previous one. So and that is what you will see here, and it's one of the products that we put on the cash flow. You'll notice when we look at the cash flow statement, this is one of the figures that will go there. Okay, so as long as you put as long as you fed in these details and the assumptions, ladies and gentlemen, you don't need to worry about what happens on the back. I'm just trying to take you through what happens, but it's not, you don't need to master the formulas or whatever. Okay, once we've done the working capital schedule, which has the accounts receivable, inventory, and payables, and we now know the net working capital, and we know the change in net working capital, we can go and look at our depreciation schedule. Now, our depreciation, the way we've computed in this one, we only looked at property and equipment. Instead of going, calculate the specific depreciation, which I'm not an account, I don't want to spend a lot of time re-evaluating. If I already have the past, then I can use it to determine the kind of depreciation I'm going to have. So all I'll need to do is I look at, okay, I have property, I already fed there. Then this capital expenditure is what you put on top. How much, remember on this assumption, we put capital expenditure, okay? There's capital expenditure here. So I can say in 2021, I'm going to buy machinery, equipment, that is going to be 45,000, okay, 450,000 maybe. I'm going to buy on year 2, no, I'm not going to buy. On year 3, maybe I'll buy something worth 50K. On year 4, maybe I'll buy something worth 60K. Okay? This is capital expenditure. Now, that is just the amount of money that you intend to spend to buy assets on that particular year. That is the figure you need. Once you get that figure, remember here we made an assumption that our depreciation is 40%. In other words, because from the past depreciation, it seemed that most of our equipment stays with us 2.5 years. That's why it's 40%, 2.5 years. Okay, it takes 2.5 years before we dispose. So I'm just going to keep the same assumption, and I know the capital expenditure. And using this, I'm just going to go down on the supporting schedule. Okay, what was the property and equipment? It is this. Okay, how much am I going to buy? It is just going to pick from the assumptions there. Okay, so I'm just going to stretch this. I'll stretch it until it will give me the number. Sorry, and let me just get it again from the from the assumptions. Where is the capital expenditure? It is here. So I'm just going to pick it, okay, and stretch it. So it will pick the other expected expenditures, okay? Okay, so it has picked all of them, okay? Now, after it picking, it says, oh, sorry, this is, sorry, let me just repeat this. Because the opening equipment is usually the closing of the other year. Ideally, this should be this, sorry. So I need to put this, this as this, okay? So that is what we are going to have here, okay? Okay, and then here I'm going to have the, yeah, That is already clear. Then now depreciation, which we saw depreciation is 40%. So I'll just pick 40% of the current property that I have. Okay, so it will be this total multiplied by 40%. So I'm just going to pick the 40%, just going to correct this, is equals to this, in brackets, sorry, this, it's this, plus this, times the percentage depreciation. Already defined in the assumptions. As you can see, once the assumptions are done, most of these things just flow. Okay, so it has already brought the figure. Okay, so the depreciation will be okay. Okay, and you can see all the numbers now just come into place. Now I'm going to have this as 45 instead of 450 because my figures I'm using smaller figures for purposes of standardizing. Okay, so I've done the working capital schedule, I've done the depreciation schedule. So I have figures that I can feed on my balance sheet and cash flow. Okay, you'll notice the balance sheet and cash flow require these figures. They require these figures. Okay, they require this. You'll find the balance sheet will always ask for the closing because that is property and equipment on the balance sheet. You are going to see where it falls. And then you'll always see receivables, payables, and inventory. So when we have these figures, depreciation will go back to our income statement. So now, when we have this, my dear friends, that means we have the figures that we can feed. The only other thing that I want us to compute on our working schedule is this debt and interest. So if we took a loan, so here it is saying there was an opening debt. So there's debt opening and closing. It depends on how you are paying the interest. So we are going to assume, am I going to take another debt? We are going to determine that on the assumption, okay? Let me first, issuance, because when you pay, it is a negative. When you receive, it's a positive. So I'll put here 20,000. Okay. So here, okay, here he was paying back. He had a loan of 50, so he was paying back. So you put 20, sorry. Okay. Okay. Okay, so that means the opening date is always equals to the closing date. Okay, so I'll just pick this and pick from the closing date here. Okay, that is the opening date. Okay, so that is how it works, and I'll just continue stretching this. Okay, okay, and I'm just going to correct now in terms of date. How much money are we going to ask for outside? Okay, and that's all that we filled in the assumptions. So I'm just going to the assumptions here, and I look at date. Where is date? The date was here, issuance. So here we are indicating if we are borrowing or paying. So he had borrowed years before he captured records that he had a loan of 50K, and he paid 20K. But along the way, he may decide to borrow. So I'm just going to say, okay, maybe he decides and borrows 50,000 again. Are we together? So that means when I put 50,000, ideally when I come to my debt, my interest and debt, where is my interest and debt? Okay, so when I come here, this one is not supposed to be in blue. It's going to be derived by the formula. So all this is going to be in black. Let me first change it to black. Anything in black, just ignore because the formulas will do the work. Okay, so I'm just going to extrapolate again. sorry. Okay. Yeah. Okay. And then I'm going to also get this from the upper side, because it's what we have in the assumptions. Where's the assumptions? The assumptions are here. This is the debt. Okay, so I'm just going to pick this and stretch it. And I'm going to change it. Sorry, I have to delete this first. Let me remove the cell referencing. When you see that blue line, it means I've repeated some formulas under it. So I need to delete it first. I'm just going to pick it directly from top. There you go. Okay. And stretch it. Not again. Okay. Okay, let me just repeat this again. Sorry. Okay. Okay. Debt, this is equals to this. Where's F21? Yeah. Okay. 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 And okay, let me first remove this. Where's the 50 coming from? Okay, I'm just going to type that directly because 50. All right, I see why. Okay, so I need to first have this hard coded, because here we had coded everything. So I'm just going to hard code here. Yeah, that is the reason why. I think the rest is now okay. Wondering why that happened, but now it's sorted. So when we come to the debt schedule and we pick this, I'll repeat that again and get that, and it is that, and I'll stretch it. All right, everything is now okay. So now we now have other figures that we can use. I'm going to turn this to black because it's derived, so you don't need to worry about how it will come about. And the only thing I'll pay attention is interest. And how do we calculate interest on debt? The interest is a percentage we already put up here. We already said our interest on debt is on average 4%, okay? In Uganda, the context, our interest is usually, if you are getting money from the bank, it's usually between 18 and 24, 25%. If you're getting from a microfinance, it's usually above 25, actually above 30 to about 60. Yeah, from a money lender, it may be about 120 or more. Okay, so we are going to use the interest to calculate. Let me just pick. So when we go to our debt, so it just calculates, okay, based on this debt, what is the interest we expect to pay? So I'll just pick the debt, okay, the debt multiplied by the interest on debt, which you already assumed here. The number is already there, okay? Okay, so you already have your interest on debt, the interest expense. Now, ladies and gentlemen, this is where the mountain is. But once you finish the mountain, the rest you are just feeding, okay? Now, because we have finished this, the rest is just filling. Because now, when I come to my, where, I'm just now going to start filling. As you can see, even naturally in some places it is filled. So depreciation, we already calculated depreciation, okay? So I'll just say equals to, and go to the depreciation on the working schedule. Where's the working schedule? Depreciation is here. So I'll just pick it and put there. Okay. And since it is there, I'll just stretch it. Okay. Now the depreciation is there, it's complete. Okay. Are you see? Then we have interest expense. Where's interest expense? Interest expense is also there. I just go. Where's the debt and interest? I'll just pick the interest expense is here. Okay, and I'll just put enter and it will appear. So the interest expense is already here and I'll just stretch it. And now it is done. I'm just going to remove these things. I want to work with figures direct. Okay, so basically, what else is remaining? Tax, corporate tax. According to, in Uganda, corporate tax is 30% as far as I'm concerned. So I just maintained the ratio of tax. So since we had already put the formula, and in the formula I said if there is a loss, then it doesn't capture tax. So that is why there are places you are seeing it has not put, because it means the earnings here were a loss. So there is no need to compute tax. So here there was a net loss. Okay. Yeah, so the income statement totally complete. Balance sheet. Now when we go to the balance sheet, ideally the cash flow should not be complete, but because I had already made it as a model, it looks like the other bits are actually, yeah, but I need to first release this. And that's why you're seeing it's not balancing. Why? The cash flow is one of the last things we shall handle. Let's first handle the other things. Okay. So we filled, okay, accounts receivable filled, accounts inventory filled, property and equipment. Where's property? We go to F93. We already have property and equipment on that schedule. As you can see, as long as we've done the schedule, other things fall in place. But handling the schedule is the one thing that you need some little of patience. Some patience is required there. Okay, so here property and equipment. I pick the closing property and equipment because it's the end of the year. I pick the closing property and equipment, and I pick this and put end. Oh, sorry, I need to first have selected where's property and equipment. Property and equipment is this. I want to be sure that I have picked the right thing. You know, okay, property and equipment. Let me go and pick my property and equipment down here on my working schedule. Property and equipment is here. It was right. Okay. Okay, it was right. It was right. Okay. So you've noticed that once you've done the other schedules, everything seems to just flow. You are just enjoying, the numbers are just falling in place. Somebody say, but this person, how do they understand the numbers? What? You've done the assumptions, things are just flowing in place. Things are just flowing. Say, Okay, so when we go to the balance sheet is basically complete with the exception of the banking cash, because usually it's the last one after we finish the cash flow statement. So let's go to the cash flow statement. On the cash flow statement, we bring the net earnings. So the net earnings come from where? The income statement. It's already there. Depreciation, we already calculated. It's already there. Changes in working capital, we already calculated. It is there. Are you saying the cash flow has already just filled itself? Okay. Cash flow. So it's just, so at the end, it will just total up and say cash in operations. This is what? This is the cash in operation. Then we look at investing in cash flow. So sometimes we invest in, okay, the amount of money we said we are going to invest in capital expenditure. It has already picked it. Are we together? On the assumptions, we already picked it from the amount of money we said we are going to spend. So you are not feeling, it is already automated there. Where are we? Issuance of debt and we already captured that on the assumption. So it's already filled. Repayment of it, it's already also filled. It's already captured there. Net decrease. So this one just now computes based on how the cash flow works, and it highlights everything there. Okay. So now based on this, now it picks, we are going to pick this and now finish with our cash flow statement. Okay. Because now this, the closing cash balance is now what we pick and put on our balance sheet. Okay, so usually that is what we pick. Questions for me? Gosh, this is not one of the easiest things to teach. I don't know even if we are together. But I hope you have an idea now. Yes. Yes, please.
Yes, we have an idea. However, the numbers, it's going too fast. I'm not getting the numbers. I think I need to take it one step at a time.
Okay, so let me first receive questions concerned. Do you think this is something you can chew, or there are some challenges? Because I'm going to summarize and you'll realize that it's simpler than you think. Karen, I think what you're trying to do is you're trying to understand the how. Me, I just want you to understand the what. Because the how, if you put yourself into understanding, it means you need to do some background work, okay? But if you know the what, you know your business, you know the cost of, you know how much you spend in this. So when you have those figures and you feed in, the document will handle for you, okay? So that's what I can just simply say for now. And emphasis is what is in blue you feel, what is in black you don't feel. Because what is in black is derived by a formula. So you will start with the assumptions, okay? Actually, you will start with your historical numbers, put the historical numbers down. Actually, let me explain while I'm sharing this statement, okay? I'm still going to refine it further before I send you. But the first thing, many of us already have, oh, sorry, I thought I was sharing, I was not sharing. Let me share. So Karen, to simplify it, the first thing, start by feeding, feed this. These things in blue, many times you have these details, okay? Assuming you capture your documents. If you don't, then I'll recommend you do the assumptions the way I did in this tab 1, financial one, where you say, oh, units, 5 customers, 10 customers, something like that. It can also work, okay? Feed in this, feed in your balance sheet for the historicals, okay? Once you feed in, it will fill our assumptions here, okay? And that is the starting point. Once it fills these assumptions in black, because it will derive formulas based on what you feel. Now, once it fills, it informs you what kind of assumptions. You cannot be, your revenue cannot grow by 16 and 11, and you say now it will grow by 1,000. Okay? Chances are, if moderate, it may be 50, 60, okay? Because it has to grow systematically many times, okay? Unless some huge immediate change happens, which rarely does, okay? Cost of goods sold, as long as you filled, it will calculate this. All you'll need to do is now fill in based on your projections. I think salaries are going to increase. If we're going to hire 5 more people, the salaries per year will increase by this. Rent, I think we are going to be in the same place for the next. So I think the overheads will not change much, but maybe our cost of production may increase because of ABC. So you put that. Our depreciation. So on average, since you already put, okay, since you put, here you just put, okay, what okay, based on the past, what is the depreciation of your equipment likely to be? You can maintain it, or you can even get an average of that. Interest, if you have been receiving money at interest of 25, 30, whatever, you can as well maintain that interest for the preceding years. Tax, you know, that is defined by URA and the government. It's not for you. You just feel, okay? For the receivable and payable days, as long as you had put your details here on the, sorry, what is this? As long as you had fed your accounts receivable for the past, okay? If you put your past, it's easy to now make an assumption, okay, chances are it's likely to maintain. There's no likely to be a very big change, same to inventory days and payable days, okay? For capital expenditure, here we are asking you, okay, you've bought machine 15,000 or 15 million, whatever. Okay, in 2021, you are going to buy machines of how much? You just put machines. Okay, are you going to get some money, or do you have some money? Are you paying, or you are receiving more money? If you are paying back, you put negative. If you are receiving, it is a positive, because positive means money is coming in. Negative means money is going out, okay? Equity, the same. If you are receiving, it's positive. If you are paying, it is negative. Same. Now, once you've finished these assumptions, and that is really the bulky work, you've fed in the historical numbers and you've fed in your assumptions. The rest, the numbers will flow. The only thing you'll be required to do is now to go back on your working schedule, okay? And then on the working schedule, as long as you put these inventory days and stuff, most of this will just be filled automatically, because it computes automatically, because you already put the financials. These ratios, maybe I'll just mention a bit about the ratios here, but I hope it is clear. As long as you put previous numbers and you put the assumptions, the rest, the formulas will do it for you, so you don't need to know the how. I think the struggle is, how is it? Do I have to know this formula? We don't need you to know any formula for now, okay? Because Excel has done that and simplified that for you. Okay, so I'm just going to talk a bit about the ratios so that you understand some of what these ratios mean, okay? And that's the last thing I'm going to mention about this. Let me just see which one I was going to share with you on the ratios. Okay. Ratios, financial ratios. Now, you see, when you do your income statement, we always look at our financial ratios. These financial ratios help us read or understand our statements, okay? They help us understand what we have come up with, because sometimes we don't look at it. And I think I appreciate the question that came up, that what if I keep money accounts, does accounts receivable and payable affect a business? The answer is very much a big yes. Why? It's a big yes because if you don't manage your cash flow, that means you have to plan to borrow money. It's as simple as that. You have to plan to borrow money. But if you manage, then you don't need to plan to borrow money. So that is why it becomes very, very crucial. Okay, so let's just look at the financial ratios. Okay, these are the common financial ratios. You'll find others out there, but these are the common financial ratios. Return on sales, or ROS, return on investments, that's ROI, return on equity, debt over equity ratio, internal rate of return. I'm not going to calculate internal rate of return for you because it's another based on, we need to create what we call free cash flows. But return on sales, it's very simple. Already on your income statement, you have EBIT, earnings before interest and taxes, okay? Over your revenue, which is net sales, and that gives you return on sales. And usually you'll see it in percentage. You don't need to master this formula. the formula is already on the Excel. As long as we have return on EBIT and net sales, it will calculate for you. So you don't need to worry about, do I need to remember this? Does it make sense? No, no, no. You don't need to worry about that. Okay. Same to, let's go. Return on investment is EBIT over net invested capital. Net invested capital is current assets plus current liabilities is equivalent to net invested capital. So when you, current assets plus current, fixed assets plus current assets, I'm sorry, fixed assets plus current assets. So return on investment means earnings before interest minus, divide by net invested capital, okay? And this is also on the Excel, you don't need to worry, but I'm just explaining. Return on equity is also the same. It should be net profit over shareholders' equity. So what you've invested, net profit over shareholders' equity gives you return on equity. And you will see it, all these, I just thought it was worth mentioning before you see them. They are all here, okay? And I'm going to just align the formula so that you will see the formulas. We just know that net invested capital is there. Return on sales, the percentage is there. Return on equity, the percentage is there. And then based on the figures you put, it will also give you graphs, at least on a simplified level. I'll beg to end here. I know it has been some heavy pumping, but I hope it's really the logic that you'll pick out of this. Any questions for me? I'll beg to answer any questions from here. Thank you. Feel free to ask me any questions. The one thing I'm going to encourage all of you, number one, when we share these statements, financial statements, please work on them. We are going to meet on the 14th. That is 10 days to come, physically. Make sure you have worked on it. We refine it together. That is the easiest way to move faster with this. So I'm just going to kindly request, please work on those financials, put your figures, just all you need. And the only thing I'm asking, put your figures, make the assumptions. The rest, even if it's supporting you physically, we shall support. Just put your numbers, put the assumptions, and we shall handle the rest. Okay? That is all you need to know. What is in blue, you can change. What is in black is a formula on the Excel, and that is like a standard when we are doing the financial models. All right, please ask me any question on the financials, and we shall elaborate more. I would really encourage that you try, and when you find a challenge, you reach out. That is the best way you can. Okay, I want all of you, even if you're not financial experts, understand your financials. That is key. You may not be a financial expert, but understand your financials. The essence why we are going through this is we are not trying to make you an accountant. In fact, this is corporate financing. So it's not like the typical operational accounting, okay? It's corporate financing, and it is used to evaluate and predetermine the future of a business. And that's why when you are doing your business plan, we look at this as a very critical component. And that's why you can justify, if we go further with this, we can even evaluate your value of the business. As I said, we can evaluate different scenarios, and that is something that eventually investors normally use in the discussions. So why we are going through this is we want you to understand what you are doing, because when you understand what you are doing, trust me, it will inform which strategies. I need to invest more on. This can be a variable cost. We don't have to have a fixed cost. Do we need a warehouse permanently? We shall pay as and when we have goods there. I don't know. You see, at the end of the day, these numbers inform a lot. Your receivable payables, the same way Musa asked, they inform a lot. Please ask any questions, any questions, any questions, any questions. In the meantime, I'm going to ask each of you how it has been. Mr. Rico, please repeat for me the financial ratios. All right, let me repeat the financial ratios. In the meantime, I'm just going to stop recording because that was the basic.